Good afternoon. We're Team Monte Carlo Capital. And on behalf of Monte Carlo and Nora Wealth Solutions, it's our pleasure to be here with you today. As Nora's research team, our job is to use rigorous analysis to uncover opportunities to enhance our platform and drive our growth into the future. And that growth and how we get there is the story we're here to tell today. In recent years, Nora's growth has fallen behind that of our peers because our products no longer meet the needs of our high net worth clients. Clients are increasingly seeking exposure to alternative assets, and our competitors offer these products, but Nora does not. Expanding our products into carefully researched alternatives will allow us to attract and retain clients, increasing our revenue by growing our assets under management. Of the 3 products that we examined that passed our initial due diligence, we're here to recommend the 2 that we believe our clients will find most attractive. The first, NREC, offers the closest alignment with their needs, while NREC, a debt fund, has excellent diversification and is an absolute return vehicle. Now, we've selected these products because of their alignment with the needs of our clients, as well as the needs of our firm. So we'll start by taking a look at what those needs are. Our research indicates that high net worth clients are looking for stable income generation with low volatility and favorable tax treatment. They want capital appreciation, but not at the expense of higher risk or illiquidity. And they want products that will help them diversify their portfolios. From Nora's perspective, we need products that will appeal to our clients. That means strong performance relative to benchmarks, products that are diversified, and that have low risk in the near term, particularly that early adoption period of 12 to 18 months when we prove the concept to our clients. The products also need to be easy to onboard. This means no extensive due diligence, no complex structuring, and they need to be easy to explain to our clients who are more accustomed to traditional stock and bond portfolios. So the bottom line is we need products that will appeal to our clients and that are easy to onboard in order to grow our revenue. When we take a look at all of these priorities together, we see an area of convergence around stable performance and diversification. Now, we'll consider stable performance in terms of performance relative to the NPI benchmark, as well as the right income and appreciation profile. And we'll look at diversification across asset classes, as well as a low correlation to stocks and bonds. And taking these interests together, we've developed our scorecard that we used to evaluate each product. We'll come back to each of these criteria shortly, but the important takeaway from now is that NREC scores well in every area, while NREC's strength in the key areas that matter most to our clients overcomes its limitations in other areas. So having looked at what our clients need and what the firm needs, the question becomes, what's going on in the market right now that makes real estate alternatives, and specifically NREC and NREC, the right solution now? Alex?
Thanks, Logan. So one of the first things we want to talk about is diversification. And in recent years, stocks and bonds in the traditional 60-40 composition has reached a highest correlation coefficient. What this means is that our clients not getting what they want, which is diversification. So the question for us became, what does? If you look at the left side of the slide, you see that CRE debt and CRE equity provides what we need, because against stocks and bonds, they have the lowest correlation coefficients. However, we don't want to neglect our returns either, risk-adjusted returns. If you look at CRE debt and equity on the right side of the chart, you'll see that it has the highest relative returns against risk. So next, let's talk about our high net worth clients. So we've marked up 5%, 5 million and under against 25 million over for high net worth, total net worth. And what we see here is that the alternative and real estate composition for under 5 million is around 25%. However, if you step up slowly, incrementally to over 25 million, that composition dramatically increases to 40%, dwarfing the other investment vehicles. What this means for Nora is that we have a unique opportunity to invest in additional funds, such as alternatives. So over the next few years, with the launch of the 2 products we're going to talk more about today, this is going to transition our portfolio from a traditional 60-40 composition slowly over to a 50-30-20. And that 20 is alternatives. Where does that 20% come from? Well, the simple answer is that we've seen it work already. We've seen other institutional investors allocate similar proportions to their alternatives. Here, we use CalPERS as an example, but there are other institutions who did the same. Within that 20% of alternatives, largely it's within real estate. And within real estate, much of that is in core products. So what we're trying to say here is that we're not reinventing the wheel. We're taking a playbook that's already worked and we're just running it back with these 3 products. So first, RCREF. Technically, this is a private credit, but we understand that this is based on strong real estate fundamentals. And we'll talk more about that as well. And the next is SCRED and NREC. There is a difference here, although they are both real estate products. And we'll dive into that as well. So, in aggregate, we've mapped out the portfolio composition of different products at different ratios. And this is what our allocation of additional products does to us. It shifts us upward and inward on the risk-return scale, taking us from 60-40% upward, increasing our risk-adjusted returns, and inward on this shift to reduce our risk and volatility. Looking at the indexes. On the top, we see S&P 500 as standing for stock volatility. On the bottom, we see MPI standing for real estate. You'll see that the stock volatility is at roughly double digits, while our MPI volatility is single digits, meaning that this creates the stability that our clients are looking for. So now that we talked about some of the key drivers, let's talk about the criteria that we used for each analysis. Namke?
Thank you. So from now on, I will introduce our criteria and then walk you through how the potential 3 options were evaluated and scored by each criterion. So first, we looked at income and moderate appreciation because Nora's clients are requiring stable income and at the same time, moderate level of appreciation. So under this criteria, NREC is getting a highest score because it's actually investing in core asset class, so we can expect a steady and stable income stream. And RCREF is actually providing stable income, but their expectation of moderate appreciation is relatively lower than others. And the SCRED has the lowest score is because of their strategy change to development actually reduces their stability of income. And next, we analyze asset diversification. So under this criteria, NREC and RCREF have a high score because those 2 funds are investing in multiple various sectors of the real estate. On the other hand, SCRED is only investing in industrial and multifamily, so we cannot expect a significant diversification effect when we are investing in this fund. And next, we consider the return relative to MPI, which is our benchmark. So in this criterion, only NREC has offering the proven index-related return, and RCREF is offering the absolute return target, so it's not benchmarked, and the SCRED is benchmarked against MPI, but again, because of their development strategy, they are highly leveraged potential fund in future, so it's not appropriate to be benchmarked against unleveraged index such as MPI. Ayush.
Thank you. Building up on that, if we look at the potential leverage overload for SCRED, especially in times of impending debt maturities, we see that it's going to be extremely risky to enter into a leverage analysis with SCRED. Having said that, NREC and RCREF are way below their 60% LTV threshold, which is not going to be a problem for these 2. Now, all 3 of these non-traded REITs qualify as accredited real estate investment opportunities. Now, what that means is that every time an investor, a high net worth client, invests into these 3, they're going to get deferred tax gains and at the same time bank on long-term capital gains tax rates. There is going to be additional pass-through securitization required for RCREF because it qualifies as a US trade and business because of it being a credit vehicle, but we can come back to that. If we look at liquidity, which is one of the main criterions for our high net worth clients, we realize that NREC, being an open-ended vehicle, is going to satisfy most of its liquidities because of its redemption queues. Whereas for RCREF, the secondaries markets for private credit have not yet been that evolved. But the sponsor will for sure provide illiquidity premium, as is the norm of the trade. When we look at SCRED, it's a core but closed real estate vehicle. And because it's closed-ended, liquidity is going to be an issue for SCRED. When we look at the summary of everything altogether, we realize that NREC definitely passes with flying colors. But there are certain red flags that concern us about the other two products. I mean, for RCREF, the yield and NPI relative returns are not really a red flag because they're not benchmarked against the NPI, but giving the highest absolute returns. And why wouldn't our high net worth clients want that? When we look at SCRED, it's strategically misaligned at this point, and it's very risky for our clients to get into the business with that. Now that we have looked at all of our criterions, we're going to get deeper into all of these products and see why NREC and RCREF earned our endorsement.
Thank you, Ayush. Now, let's take a deep dive into the product. The first product that we recommend is NREC. NREC is an open-ended core fund providing stable cash flow, liquidity, tax efficient, low leverage, and diversification. NREC consistently outperforms its targeted return from near-term, short-term, and long-term with a realized return. Apart from the return, the anchor tenant under the shopping mall might be a risk to NREC. However, we believe NREC has the cash flow to cover that, and the retail sector only takes 4% GAV, so we think it's not a substantial risk. For the SWOT analysis, the redemption queue might be a weakness to NREC, but NREC holds a track record of fulfilling all the redemption queue on time, so it's not really a weakness to NREC. For the strategic analysis, NREC has 90% AFFO, showing strong liquidity. Therefore, we recommend onboarding NREC. The second product that we recommend is RCREF. RCREF is an open-ended real estate private credit fund, chasing for absolute return that is not benchmarked against MPI. Although private credit might be a complicated product for our clients, but actually we think it's a good option because RCREF provides absolute return, which is different from other product that's benchmarked against MPI. So they are a diversified risk-adjusted return. RCREF targeted return is 8 to 9%, and their realized return is 10.6% right now. In the future, it's projected to be in a similar range. Over-leverage might be a risk for RCREF. Currently, RCREF is sitting at 74% leverage, above their original 67 LTV, due to the recent interest rate correction, value depreciation. But with the future interest rate cuts and value appreciation, we believe that will bring down the leverage level for RCREF. Also, life science might be a problem to RCREF. If the anchor tenant vacates, RCREF will take the loss of the loan. But the life science sector only takes 4% GAV, therefore, it's not a substantial risk to RCREF. Looking at the SWOT analysis, RCREF, again, provide absolute high return that is not benchmarked against MPI. And for strategic analysis, the SOFR floor actually provide extra downside protection to RCREF. Therefore, we recommend onboarding RCREF together with NREC. The third product that we do not recommend is SCRED. SCRED is a closed-end core plus fund, and actually it's shifting from core plus to value add with future development plan. SCRED didn't outperform its targeted return in a 1-year time horizon based on the realized return, and we think this is a red flag because our clients are targeting stable return. With the strategy shift, SCRED is shifting from core plus to value add, chasing for appreciation over income with higher leverage and more risk. Also, for SWOT analysis, SCRED, with the future development, that's in the planning right now. It might bring the S-Creed leverage level up, causing them to breach their covenants. For the strategic analysis, 40% of the loan will mature in the next 12 months, and we think that is a problem for S-Creeds. Therefore, we do not recommend onboarding S-Creeds. After we take a deep dive into the product, let's take a larger picture of a strategic recommendation. Irina.
Thank you, Michael. We've seen a lot of data. We've talked about each product separately. Now let's look at the bigger picture. Let's see where we are today and where we are recommending to head to. This is the graph of efficient frontier. In gray, you see traditional stock and bond portfolio from the return and risk perspective. Let's see what happens if we add NPI, private real estate, in our portfolio. And let's see additional commercial real estate debt effect on it. We see that the efficient frontier moves upwards and inwards, meaning that our clients would be able to generate higher returns at lower risk. So basically, at every point of risk, they can generate higher returns, moving on this line up and down, choosing their own portfolio allocation. Commercial real estate debt has the most impact on the efficient frontier, while NPI is the most used in real estate. So if we were to choose additional private real estate opportunities, if we're given a blank check, this is the 3 asset classes that we have the highest conviction in: senior housing, student housing, and self-storage, given their market fundamentals. Moving forward, if the first rollout succeeds, we think that there are more opportunities for our clients to diversify their portfolios. With NPI and CRE debt on board, we conducted the Sharpe ratio analysis, and we think that some of the products here can generate high returns at lower risk, even further on addition to real estate. So if you look at the green lines here, they represent infrastructure, commodities, and hedge funds that are in low correlation with traditional asset classes. We've analyzed public REITs and CMBS as well. They are highly correlated to traditional stocks and bonds. And I know this is a lot in this chart, but if we look at the first graph, it's the returns, then there's standard deviation, and we derive the correlation based on different data points. And that's how we calculated the previous efficient frontier in the previous slide.
So let's try to tie everything back together. We looked at the microscopic product overview, and then we looked at a strategic recommendation. We realized that by opening up our clients' portfolios to this alternatives funnel that is coming up in front of us, we're going to have extremely accretive returns with diversification benefits. By today saying yes to NREC Real Estate Equity Fund and RCREF Real Estate Credit Fund, in the next 5 years, we are going to be as good as our peers in terms of wealth solutions. We were before at 7.2% CAGR, but by onboarding this and by a successful adoption, we believe that we can take Nora to more than 10% CAGR.
As we said, Nora is falling behind our peers in terms of growth. And this is because our products don't meet our clients' needs. Clients are looking for real estate alternatives to add to their portfolio. And we believe that RCREF and NREC offer the best combination of risk-adjusted returns, diversification, and ease of onboarding onto our platform to give them those opportunities. Onboarding these products successfully will position us to build out a broader alternatives platform touching real estate and beyond, driving long-term value for our clients and for the firm alike. So this concludes our prepared presentation. We'd love to take your questions.